We have a trigger now on the 15 minutes. We buy immediately. We actually are going to be buying oil on risk aversion, risk escalations, and that would mean that markets are risk adverse. We should be seeing this also on the analysis. It's the same. We didn't have a trigger earlier. Now the fact that we're having a bit of lower employment claims means the markets are in a way satisfied that what we've been seeing as soft economic data out of the United States is probably just neutral readings and does not mean the start of a recession. If you're getting retraction in the current of unemployment claim numbers, it means that there's still work probably for everyone, and it's not like we suddenly saw a sudden rise in unemployment claims to 200,000 and so on. Right, so there doesn't seem to be restricted economic activity. It is still the driving season in the United States. We are having now a war, I believe, in Ukraine, between Russia and Ukraine. Ukrainian troops yesterday, or maybe even the day before, crossed into Russian territory, and we're about to have a war in the Middle East too. So we should be seeing higher prices in oil. We have a bit of a trigger here on this 15-minute chart. Let's take a look at this very quickly. Again, we'll move straight to trade management, and then we can revert back to the live market. We see the same structure. You see a 1 and a 2, 3 and a 4. We didn't have a trigger when this was drafted. Now we have a trigger. This is high degree B, and we believe we're going to be doing a high degree C. We believe there's going to be a 1 and a 2, 3, 4, and a 5 at the neckline. 78 is the most probable target, even if we do not yet have escalations. And then we fall back and do shoulder levels. You can see here shoulders to the left and shoulders to the right. Possible that we get a rejection at 76, then fall back and move to 78, and then begin to do the shoulder levels. But I believe that because of the current escalations going on, the projection is 78. 78 is really the higher degree target showing here on this 30-minute chart. This is now a more broader version of the 30 minutes. That green neckline is actually a support level. It's a level 1. So we dipped below level 1, but what's going on is that we're just doing something like an inverted head and shoulders below level 1 at the 200-point moving average, now correcting to 78. So the most immediate target for what we're going to be buying is 78. Of course, going into the end of the week, we'll probably hold a position, maybe take a half-size profit, but just hold the position because any escalations across weekends, and this is a very, 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 very strong possibility. Usually escalations happens on weekends. Any escalation across the weekend will take us to 80, will take us actually to 84. We have 84 right there. This is just the 45 minutes, and this is that leg A and B. So that B is this B that we're seeing here, and we should be bouncing out into a C. And a C, of course, must at least equate with an A. So if it does equate with an A, it's 84. If there is severe escalations, we go to 88, we go to 90. That's why we have to hold a position across the end of the week. All right, so we will get dips, but I believe the market is still a buy. We did the longs, of course, about day before yesterday, so we should be long at 74, I'm sorry. We have a hedge at 71.60. These labels, I believe, are now correct. We can, we can move the hedge to level 1, as a matter of fact, which is 73.20. I can just dip below this internal resistance or this internal support makes my entry to internal supports from the entry. Assuming I do the entry today, of course, or I already have the entry, they're very close to one another. I'm either long at 74 or 74.60, $74.60. And the hedge is that yellow arrow here. Again, two internal supports from the entry on a 15-minute chart is 72. So between 74.60 and 72.50 is about $2. It's a hedge and not a stop. meaning if it does get opened, we just take profit 50% between this internal pivot level at 72.70 and the next internal pivot level is support 2 at 70. 50% is 71.75 in between. You do not hold hedges. You just take profit and keep holding the long and have another hedge below the market bottom that has just been generated when you took profit on the first hedge. Probably the market moves higher and that is the end of the story. All right, so let's take a look at the triggers. I believe we have a bit of a trigger at this point. I also believe maybe we are seeing an ascending triangle. Okay, so if we are seeing an ascending triangle and the current break to the upside was just what you call knee-jerk action, meaning the market is expecting escalation or expecting something to drive prices higher and overreacted on the current release regarding unemployment, the weekly unemployment claims. Overreaction means that we have a 1 and a 2, we have a 3 and a 4, that the market will not have legs to carry on. We get a 5, maybe a 5 will even do 75, but will take all day long to go there and there is no continuation really, right? And we have done something like 5, we retract back to test the upper boundary of this ascending triangle. It would look like we are doing shoulder levels, but we believe the pattern is correct. The pattern, of course, is showing splatter momentum and therefore is probably correct. Remember, this is the level 1. We should break above it and begin to support above it if this is going to be a bullish market. And we believe, of course, on escalation, so we can hang around on top of that ending diagonal. Of course, this 5 becomes a higher degree A and a higher degree B. You can take all the time you want to do something like shoulder levels. So I can probably get higher degree leg 1 or higher degree leg A. Then higher degree leg B. And then if we have escalations, we just have a very strong break to the upside. So there are other reports that Mr. Putin is intervening with the Iranian leaders to avert escalation and to try to mediate between Iran and Israel, right? So maybe this will delay escalations and we don't get them this weekend. Assuming these efforts fail or the Russians become more concerned about the current offensive out of Ukraine, we may get still escalations across the end of the week. Once we get that escalations, we believe we break that old neckline. And again, the target, of course, is 78 and 79. All right, let's take a look at the high degree momentum. So it is possible, of course, that we still get lower levels, maybe $73.85. I believe it's best to be on the long side because escalations could occur really at any moment. And therefore, even if they do not occur, the threat that there are going to be escalations will keep buy pressure on markets. And therefore, oil is a very good bargain at $74.50, at $73.80, around these levels. Once we get escalations, probably we're going to have a very strong move to the upside. Let's take a look at the internals first. So it's not really very strong momentum, just tepid. Are we beginning to get triggers on the 30 minutes? We may be about to get a trigger on the 30 minutes. If we get a trigger on the 30 minutes, if there's continuation, if we still get continuous positive momentum on the 5 and 15, we haven't really seen this yet. We'll just have a very slow or poor positive momentum on the 15 minutes. If we get a trigger out of here, it would mean we're seeing a 1 and a 2, internal 1 and 2. And when we get escalation, we get a very strong 3. Let's take this to 45. We may also get the same. We have good positive momentum on the 35. Again, if the feeds on the 5 and the 15 can break out into something positive, right now you cannot really say that they are showing good positive momentum or a trigger. They're actually more like neutral. If they become positive, this becomes a trigger. You can see this indentation in momentum is higher than leg 2, than the last indentation made, or leg 4 for that matter. And therefore, it would mean we have breakout. I believe the 1 hour is going to be showing the same. We have a trigger in the making, not yet there, but you can expect again, if there are reasons, fundamental causes, it will become a trigger. Nothing on the 2 hours. I don't believe anything will be showing as of that point. But we can see that we have cycle translation. So it's like we had a 1 and a 2, and then a 3 retraction can just take us to $73.60. If possible, we would want to investigate that level 1 out of which we have the bounce. Just an internal level 1. All right, let's take this back to the feeds, 15 and 5. There is possibly a trigger in the making here. Remember, this is on high possibility of sudden escalation. So likely that there will be positive momentum showing on the 5 and 50 minutes. And we may not really consider we have a trigger here because we have a bit of negative momentum, but negative momentum means in reality that you have taken this neckline here. If we continue to have positive momentum, then we are seeing a head and inverted, even at these very small frames or levels, we're seeing a head and shoulders at that level. Inverted, of course, head and shoulders, or a wedge. So I can draw a line here and we get a wedge, or maybe we just get a bit of retraction, but on positive momentum, and we're seeing inverted head and shoulders, dilute inverted head and shoulders. Remember the checklist we keep talking about, that whenever you're doing a trade, you want to look at the trigger, investigate that this trigger is well supported on high degree momentum. Where exactly is it going? Is it bouncing a 200-point moving average, going to another 200-point moving average on a higher degree frame, like the 1 hour, for instance? At what support level it is? The overall, of course, high degree structure. And the next thing you need to check on your checklist is the pattern, the structure, the pattern. So the pattern appears to be a wedge, really. And we believe that we are moving inside of an ascending triangle. So the maximum attraction is the lower boundary of that ascending triangle. A wedge is an adverse triangular fractal of an ascending triangle. We're above the 200-point moving average on the 1 hour time frame, which is a very encouraging sign, because usually if you're going to get a trend, you should be supported on the 200-point moving average. A downtrend rejects on the 200-point moving average. We've seen this on the 30 minutes, and you can see this happening all the time. Rejection at B, rejection here, rejection here. At this point, we had a bit of deception that the market could have moved higher, but then failed. Today, I believe the fundamentals are on our side, and we are above the 200-point moving average. So the market is long. I believe it's better again to be long than wait for a retraction, because escalations can happen suddenly, and this is really a fundamental trade. If we already have the longs, we hold them. We could take half-size profits towards the end of the week, hold remaining half-size across the end of the week. If we do not have the longs, the market is long at $74.47. We're going to have a hedge at $72.40, about $2 to the downside. And again, we'll take a half-size profit end of day tomorrow, end of the week, that is, and hold remaining half-size across the end of the week.